Thank you, Simon. Good evening, everyone. My name's Nat Floyd. I'm Head of Finance at the MPA. Thank you so much for taking time out of your evening to attend our webinar. We've got a very good one here for you this evening with Catax. But before I introduce Nigel from Catax to you, there are a couple of things I should point out. Firstly, this webinar is recorded, and that's purely so we can share this as an on-demand event for members who are unable to attend tonight. We're expecting the webinar tonight to run for an hour in total, roughly 35-40 minutes presentation, with time at the end for questions. So if you have any questions, please submit them through the Q&A function at the bottom of the screen. We've disabled chat and raise hand functions for this event, so all questions through the Q&A. If we run out of time at the end to answer all of the questions, and we'll work with Catax to respond to you by the end of this week. So, Catax, they are an NPA recommended business partner, and they'll be highlighting how specialist tax relief may be available to you, which could generate significant cash returns. I'd like to introduce Nigel Holmes, who is their Senior Tax Specialist and Head of R&D Technical Operations, who will take us through his presentation. So, Nigel, welcome.
Thank you, Natalie. Thank you.
Over to you.
Thank you. There's my slides, which is good. Yes, thank you for having me on this evening's webinar. Look forward to talking to you for about 35 to 40 minutes about unlocking hidden cash in your pharmacy, as Natalie says, through the availability of a couple of tax reliefs that you may or may not be aware of. Can I have the next slide, please? So I'm going to briefly give an introduction as to who Catax are. Then I'm going to carry out a couple of polls. And then after that, we'll go into a little bit of detail about a couple of tax reliefs that may be relevant to you as pharmacy owners. Next slide, please. I said before when I was saying about next slide, I feel like I'm Chris Whitty today, so that's quite good. So Catax, we're not accountants, so we're not here to tread on the toes of your accountant, who are probably your trusted advisor. What we are is we work in conjunction with accountants and other business people to help businesses, companies, company owners uncover tax relief that they maybe weren't aware of in the first instance, hence our tagline, Tax Relief Uncovered. We've been in existence over 12 years. We've identified over £250 million in tax benefits for our clients to date. With our headquarters in Altrincham near Manchester and offices in London and the Channel Islands in the UK. And last year we went international by opening up in Vancouver in Canada. We're a team of around 100 staff, and we're really growing at the moment. We're in a really good place despite the tough economic climate that is. Obviously people want to find money, and helping you find money in tax savings is absolutely crucial in this day and age. So we employ around 100 people, as I say, and we're spread about in both head office and around the country, home-based. Next slide, please. We're very proud of our professional partnerships with the ICAEW, that's the Institute of Chartered Accountants of England and Wales, member reward partner, and the Law Society endorsed for our capital allowance work, and we're endorsed by the Institute of Financial Accountants for all our services. Next slide, please. Like as Natalie said, we're very proud strategic partners with the National Pharmacy Association. You can see your logo there in the middle, along with various other institutions and bodies. Next slide, please. So that's a very brief, high-level overview of Catax. Before we get going, can we now do poll number 1?
Of course, thank you, Nigel. I'll just launch that now. So for our audience, you should be receiving a poll on your screen now, if you could complete that for us. Just give you about 30 seconds to do so. Okay, and I will share those results for you, Nigel. There you go. So hopefully you can see those, and audience can see those on screen now.
Excellent. Thank you very much. That's really interesting. So more people have heard of capital allowances, tax relief than research and development. Quite a lot of people have heard of both, though. But there's also, a good number of the audience who've heard of neither. So that's really interesting. So a good mix there. So can we launch poll number 2, please?
Certainly. Okay, again, audience, just going to launch the poll now. Okay, hopefully you can see that on your screen now, so please do submit your answers or your opinions. Another 5-10 seconds or so. Okay, just a few more coming in. Okie dokie, we'll stop that there. And Nigel, again, I will share those results for you. There you go.
Excellent. Really good answer, that one. Thank you. Thank you very much, Simon. So the next slide, if technology is in our favour, will be a short little animated video.
Did you know there could be money hiding in your commercial property? No? Well, there could be, and we'd like to help you find it. It's called Capital Allowances Tax Relief, and it's basically claiming back tax for all the embedded items in your building, from the lighting above your head and the heating system to the piping underground. It's pretty much anything in your building that would not fall out if you turned it upside down and shook it. We are the experts, so we know how to find the biggest claim possible. In fact, our average client tax benefit is in the thousands. With most things, there's usually a catch, but with Catax, there isn't one. If we can't identify a benefit, you don't pay a penny, so there's no risk. We only need some basic details from you, and we'll do all the hard work. So if you're a UK taxpayer and you own your own commercial property, call us now and we'll quickly work out if you're eligible for capital allowance tax relief. The money belongs to you, so let's claim it back from the taxman now. Catax, helping you uncover the hidden capital allowances relief inside your commercial property. Call us on 0330 311 1968.
So as you'll have seen from that video, the key to this is all about commercial property, and of course chemist shops qualify as commercial property. Now the common misconception here is that accountants deal with capital allowances. Now an accountant will look after your capital allowances to the degree that you're buying new computers, new fixtures, perhaps new display units, but what they won't be able to do is identify the value of the wiring and the plumbing and the sanitary ware that were in the building when you acquired it. So as I was saying, so whereas accountants claim for those items that you buy, such as loose items, fixtures and fittings, computers, desks, chairs, what our service offers is the ability to value the items that are embedded in a building. Hence why our video looks at the concept of taking a building and shaking it, and what doesn't fall out is what we claim on. So that's the premise of our tax offering here. Next slide, please. And anyone can claim this relief so long as you are a UK taxpayer and you own commercial property. So this is available to landlords and people who use the property in their business, whether you are a company, a sole trader or a partnership, so long as you have what's called a qualifying activity. And all that means is you're either generating profits from a trade or receiving rental income for your property. So in the case of running chemist shops or chains of chemist shops, you're obviously operating that as a trade, and you will be generating profits, so you can make one of these capital allowance claims and reduce your tax bill, whether you're a sole trader, partnership or company. Likewise, if you hold the property outside your business and you receive a rent for it, that also works under this tax relief. Next slide, please. And of course, today is all about the National Pharmacy Association and obviously pharmacies, but Commercial property means, as it says on the tin, offices, restaurants, pubs, warehouses, retail units, hotels, doctors, dentist practices, anything other than residential property. It even includes furnished holiday lets. So if any of you have a furnished holiday lets as a side business, it qualifies for that. Caravan parks, anything that's classed as commercial other than residential, the house you live in, or houses that are long-term let. Next slide, please. So what qualifies for the relief? Well, it's various things, but in summary, it's your electric, your water supplies, your air conditioning, sanitary ware, reception desks, is what you would say fitted into the building, either within the main flooring of the building, or indeed under the floor, behind the walls, or in the ceiling. So it's all the items that kind of make a building function. Next slide, please. Certain entities cannot claim the tax relief, so charities, because they're not tax-paying entities, likewise government bodies, pension funds, or for property developers who hold the property as stock. Now, the interesting part of this, as you'll see on a future slide, there's a special rule with regards to the year 2014, but that rule doesn't apply if you bought property from either a charity or a government body, pension, or other non-tax-paying entities. So if you bought property off any of these, so you could have bought your shop from, say, a pension fund, then you will be able to make one of these claims regardless of the 2014 rule that I'll explain in a moment. Next slide, please. And here's the 2014 rule. So to clarify, if you own commercial property and you've owned it since before 2014, you can make a claim for this relief. It doesn't matter, unlike a lot of tax reliefs where you can only claim in the last 2 years, for this you can only go back 2 years to make the actual claim, but it can be based on property you've owned 2 years, 5 years, 10 years, 20 years ago. So how long you've had the property is irrelevant. You can only alter your tax in the last 2 years, but the age of the property is irrelevant. However, in 2014, there was a slight change to the rules, which said that where commercial property changes hands in April 14 onwards, then the buyer and the seller must enter into what's called a joint election, and the tax legislation is there on screen, section 198 for freehold or 199 for leasehold, agreeing the amount of tax allowances that can be claimed by the buyer. So if the seller can maybe retain them all, they might hand them all over. So there has to be a legal agreement in place. So this now means that a few scenarios arise. If you have bought commercial property, bought your chemist shops before 2014 and still own them, this rule doesn't matter. If you bought a shop after April 14, but more than 2 years ago, you could well be out of time for a claim, but there are still areas where worth looking at, such as major refurbishment works or extensions or redevelopments. And if you've bought property since April 14, but within the last 2 years, then you can maybe revisit what's been done and get a successful claim made, depending on the seller's viewpoint. You really need the seller's agreement to enter into that, and they may be less likely so now they've wiped the hands of the property, but it's certainly not the end of the world. So if you've done anything in the last 2 years, it's worth considering. A final point on this, it's quite common these days that people who own commercial property seek financial advice and are told that it's a good idea to put it in their pension fund because then the property will grow in value tax-free. Now that's a brilliant idea, but if you do that, so long as beforehand you make one of these elections, you can keep the tax relief and offset it against your profits and then pass the property into the pension fund. You can do that if you're about to do it or you've done that in the last 2 years. So if you've transferred property into a pension fund in the last 2 years, this is worthwhile revisiting. Next slide, please. So a few common misconceptions. So I've kind of mentioned a couple of these already, but I'll reiterate them. Firstly, my accountant deals with all of that. Now, accountants, I'm an accountant myself, so I'm willing to be slightly tongue-in-cheeky and say accountants don't know everything, and what they don't know is how to value wiring and plumbing in a building. They are not surveyors, they are not valuers. So unless, as property owners, you've had a surveyor around carrying out a tax valuation on your electrics and plumbing, then you haven't maximised the claim. The actual concept is a valuation followed by plugging a lot of data into a cost model and carrying out an apportionment method, and requires a survey and report. So unless your accountant has that skill or outsources the work to firms like Catax, then you probably haven't maximised the claim. Secondly, another misconception is because you maybe hold that property in your accounts under the heading property, people seem to think that you have to make an accounting adjustment to move any items we identify into your accounts, and you don't want to play around with your accounting disclosures. That's not true. This is purely a tax issue. It's got nothing to do with the accounts. The accounts remain unchanged. The next point is crucial. I've already mentioned this. Whilst we can only go back to more or less 2 years to alter the tax available, it doesn't matter when the property was bought. So if you bought property in the early 2000s, even in the 1990s, a claim could still be valid. Any further back, we're not saying a claim can't be valid, but data gets harder to obtain. Obviously, the further back you go, values get low, so the savings are less worthwhile. But certainly bought in the kind of mid-90s onwards, ideal situation. And then the final misconception is some people, and this is something that accountants raise erroneously, is that it's only a timing difference and that this capital allowance tax relief is clawed back when you sell the property. That actually is not true. If you sell the property at a profit, you actually have no clawback, and therefore you've effectively got relief for costs twice. And that is actually not a loophole. It is actually in black and white in the tax legislation. So quite surprising that, but it's not a timing difference. It's an absolute saving. Next slide, please. Finally, to wrap up before we move on to the second tax relief, just going to share a couple of case studies. Both these are genuine Catax claims. This one, care home, purchased for £500,000, and Catax got involved and identified nearly 20% of that 500,000 qualified for tax relief. Of course, care homes, very, getting a lot of press at the moment. They're doing a great job. So wouldn't it be great if all care homes could make these type of claims and get some reward back from the government? Next slide, please. This one's really big numbers, hence why we included, just show the possible savings. This was a hotel in London. I think it's actually a travel lodge, so it shows even the budget hotels how much they cost to buy. 15.5 million purchase price, but nearly £6 million of that qualified for tax relief. So a massive, over a third of the cost of that hotel qualifying for tax relief. Next slide, please. That's it on capital allowances tax relief. I'll deal with all questions together at the end because there's certainly only one there at the moment. So we'll now move on to research and development tax relief. Once again, the next slide is a video. So Simon, do you want to make the changes again so we can watch the video?
Certainly will. Thank you, Nigel.
Did you know there could be money hiding in the work you do? No? Well, there could be, and we'd like to help you find it. It's called Research and Development Tax Relief, and it's not just about people in white lab coats. Essentially, it's the government's way of awarding businesses that are developing new or improving existing systems, processes, products, materials, and devices. You can even claim for failed projects. Our team are R&D experts, so we'll get you the maximum claim possible. In fact, our average client tax benefit is in the thousands. We'll make a full analysis of your activity and create a jargon-free report everyone can understand. Once complete, you should receive a cash rebate from HMRC or a deduction in your future tax liability. There's nothing worse than a missed opportunity, especially when it's a risk-free one. Call us now and we'll quickly work out if you're eligible for R&D tax relief. The money belongs to you, so let's claim it back from the taxman now. Catax, helping you uncover the hidden R&D relief inside your business. Call us on 0330 311 1968.
So as the video says, so research and development is a lot more than main white coats, but as pharmacy owners, you're well aware that, a lot of your items that you sell are developed by people in white coats, and they're doing a sterling job at the moment. We're all watching the news with bated breath as to what vaccines coming next, but I understand that many pharmacies won't be doing R&D tax relief if you're on the retail side of things, but some of this may be relevant to you, especially with regard to internal processes and software, so hence why we thought we'd include it in the presentation. So R&D tax relief, a bit like capital allowances tax relief, a vastly underclaimed relief. Only 62,000 companies claimed this in 2017-18, yet it is estimated 800,000 companies could be eligible. That estimate is a moving feast. A lot of people have different views on what the magic number is. There's no hard and fast way to have an accurate reading. But if that's right, only 8% of companies are claiming it. And I think the reason is what we call the man in white coat mentality. People think that R&D is just you scientists in your laboratories looking for COVID vaccines, and it is far wider than that. And as you'll see from the next few slides, why that is the case. It is only available to companies, unlike capital allowances, which is available to sole traders and partnerships. It's a company relief only, unfortunately, in this case. Next slide, please. So everyone has their own mindset as to what is research and development. To some people, it is the man in the white coat. To others, it's basically everything they do. They think they're doing R&D. But from HMRC's point of view, they've given us some boundaries as to what is and what isn't research and development for tax relief purposes. So in a nutshell, it's these 6 bullet points. So bullet point 1, that the company is looking for an advance in technology or science. Now the key here is it's got to be an advance in technology or science to your, in a particular field or sector. So if you're looking for some type of technology or science advance in pharmacy, retail, then it has to be new to the sector at large as far as you're aware, not just to your own business. Or if you're developing some new bit of software, then it's got to be new to the software industry at large, not just for your particular business. So it does become quite hard to get your mindset around that. But the way I always look at it is you wouldn't spend a fortune developing something if it was already available off the shelf in the marketplace. So the fact you spend a lot of money on it, developing it, bringing in experts, is a good early indicator that you're on the right track. Secondly, that there's got to be uncertainty to solve that advance. So the uncertainty has got to be something that isn't easily deducible, and we'll come back onto that shortly, but there's got to be uncertainty. The next bullet point is you've got to carry out something to overcome that uncertainty. So you can't just identify in advance, think, well, I don't know how you get there, and then draw a line under it. You've got to take steps to overcome it. The fourth one is that those steps could not be easily worked out by a professional in the field. So this is a hypothetical person. So would a competent professional in that field, whether it's pharmacy, retail, or software, easily deduce how to solve these uncertainties? And that deals with the next bullet point, so the answer is not readily deducible. And the final bullet point is that you don't use a standard approach. This is kind of look at what HMRC often call the baseline or benchmarking. What's the standard approach and how have you done something differently? What's your step change to do something differently in science or technology? And if you tick all those points, then you've probably got the starting point for an R&D tax relief claim. Next slide, please. These are transitioning in, so they're taking a little bit of time. What this slide is saying, and you'll see pharmaceutical on that list, obviously that's more about pharmaceutical development, but you'll also see retail. This list is a list of some sectors where R&D tax relief can be found. It's not exhaustive, there's plenty more, and we're not saying that every company within those sectors is doing R&D. What we are saying is it's far wider than people originally envisaged. So whilst probably everyone on this webinar would expect to find R&D in pharmaceutical, aerospace, robotics, you maybe wouldn't think of R&D in retail and wholesale, but as you'll see shortly, you'll see why it could be. You maybe not think about R&D in publishing, printing, even transport, but because of what R&D can be, you can find in all sorts of weird and wonderful sectors. Next slide, please. And this is the reason why. R&D takes many forms. It can include failed projects as well as successful projects, but it can include, the key to this is internal processes. So if you are developing internal processes, and that includes software development, so if you're a big chain of chemist stores and you've developed some software to allow them all to communicate with each other, and that software is completely brand new, all new code, all new algorithms, and you have to bring in a developer, and it costs a lot of money. But that could be indicative that you've got an R&D claim there. Automation, I know people have developed these automated robots that help dispense drugs. So whilst you're just buying that off the shelf now, originally when they were first devised, that would have been a really good R&D claim. So R&D can be an internal process. It's not just about the products you make or sell. Next slide, please. There's two schemes for the R&D tax relief scheme. There's the SME scheme and the large company scheme. The SME scheme is for companies that have a staff headcount, full-time equivalent of less than 500, and either a turnover not exceeding 100 million euros or balance sheet total, that's your assets total, not exceeding 86 million euros. And so long as you meet the headcount and either condition B or C, you are an SME. If not, you're a large company. And I'll explain the differences to the two schemes on a slide further along. So what's it worth? So for the SME point of view, is that for every £1 you spend on qualifying research and development, you've already had that £1 as a tax relief. You'll get an additional £1.30. So 230% in total of the qualifying expenditure gets tax relief. So the original 100% plus an additional 130%. And that's going to do one of two things, either substantially reduce your tax bill, or if it creates or increases a loss, that loss can either be used in the normal way, or it can be given up in return for 14.5% cash from HMRC. Now, the 14.5% is slightly less than the tax rate of 19%, but it's a decision that has to be taken. Do you want 14.5% cash now, or 19% relieved in the future? And most people think cash is king, let's have the cash. If you are a large company, so you've not met the definition of SME, or you are an SME that's received a subsidy, and I'll mention that on the next slide, then instead you have a 13% credit that is deducted from your tax bill. And because the current tax rate is 19%, the effective tax rate is 10.53%. So you're saving 10.53% under the large company scheme. Although it's not actually a quoted rate, if you work backwards on the SME scheme, the saving, depending on whether you're profitable or loss-making, varies between 24% and 33%. So you see the SME scheme is more generous than the large company scheme. Next slide, please. A common misconception is that if you've received a grant towards research and development, you cannot claim tax relief as well. Now, an SME cannot claim tax relief at the SME rate if it's received a grant that is a state aid, but it can claim at the large company rate instead, even though it's an SME. So you can have your cake and eat it. So in the very unusual, but it is potential circumstance that you've had 100% grant towards a project, you can have tax relief as well, so you can actually make money on your costs, which is quite bizarre, very rare. Most grants are anywhere between 30% and 70% funding. Next slide, please. So how R&D works is it's a claim made on the company's tax return, and you've got 2 years from the end of the accounting period to make the claim. But if you don't file an R&D report explaining the project in detail, that's where Catax's skill comes in, is to make HMRC understand what the project is in enough technical detail so they are unlikely to raise an investigation, then that's where our skill comes in. So you file that with the return to make the claim for R&D tax relief. So now I'm just going to give you a very, very simple example of how the numbers work. This first example is a profitable company, so a profit of £500,000. Within that has already been deducted 240,000 R&D costs. When you make the extra adjustment of 130%, that means you're getting an extra 312,000 off your profit of 500,000. So 19%, that R&D cost of 240,000 gets you a saving of just shy of £60,000. Next slide, please. Now, for loss-making companies, it works very similar up to a point, but then you've got some options. So a company has a loss of 100,000. Within that loss, R&D spend of 240 again. So your uplift is the same, 312,000. So you've now got a much bigger loss of 412,000. So the original loss of 100, less the further relief of 312,000. So you've got some options now. Your first option, always the best option, is to carry back a loss to a profit in the prior period. You can only look back 1 year, but if you were profitable in the prior period, you're going to get tax back and a little bit of interest. HMRC's interest repayment rates are very, very mean, but you will get a few pennies of interest back to put it in your piggy bank. If you're a member of a group, you can group leave that loss to a profitable company within the group, or if you're not a member of a group, the only other option available normally would be to carry that loss forward against future profits. However, because that loss has been created or increased by an R&D claim, you can now do this surrender option. And the surrender works by taking the lower of your new loss, 412,000, and your uplifted R&D, which in this case is 552, being the 240 original cost plus the 312 uplifted cost. That's where the 552 comes from. So the lower figures, the 412,000, and at the rebate rate of 14.5%, gets you once again just shy of £60,000 cash back from HMRC. But that loss of 412,000 no longer exists. You can't do anything with that now. You've given that up in return for cash, and that's how it works. Next slide, please. So just a couple of case studies to wrap up before we take questions. So firstly, this is an engineering company. It was based near Middlesbrough or Darlington. I met them in a seminar setting in Middlesbrough. This owner had already made a claim for R&D tax relief, but after the seminar had realised that he'd underclaimed, he'd missed a lot, he hadn't fully understood what R&D tax relief was. So he asked if you could make an amended claim if he'd already claimed, and because he was still within that 2-year period, he could. And from his original £1,500, we got him an extra £27,000 back in that 1 year alone, and then have since gone on and made 3 more claims for the next 3 accounting periods for similar quantums. Next slide, please. Always one close to my heart, this, because by the time I get to this slide, I'm ready for a beer. But a lot of R&D at the moment in food and drink. You know, there's lots of breweries popping up, distilleries, you know, microbreweries making beer using different ingredients, different methodologies. Lots of distilleries popping up, gin being the flavour at the moment. And in food, you know, the sugar taxes force companies to find ways to find the same flavours but without sugar or much less sugar. A massive growth in people turning to vegan foods and not eating meat, and people doing R&D on vegan products to make sure they have the same either taste or texture or longevity as other products. And lots of R&D at the moment in food and drink we're finding. Next slide, please. So I said 35 minutes, 35 to 40 minutes. I think I've nailed that spot on at 37. So just to summarise, and I'll look at the questions. So we're here to help businesses, property owners and companies identify tax reliefs that haven't been claimed by you or your accountant. We work on a risk-free basis. What that means is we charge contingent fees. So if we find nothing, you pay nothing. So any chats you have with us, there's no obligation. Even if you sign a contract with us, if we then decide there's not an eligible claim, you won't receive a bill from us. You only receive a fee if we find something or we know we found something but you decide to abort the contract. So long as we think there's a saving there, you know, there'll be a fee, but if there's no saving there, you won't receive a charge from us. We've signed up our clients on a very simple form to fill in, and you know, that can be done very quickly. I know one of the questions that's coming up is about time frame, so I'll cover that off shortly. So do you want to move to the next slide, Simon? So my email address is there, so you know, feel free for anyone to email me with any questions that come to light after this event. But now I'll read out the questions and then give answers where I may. Right. So question 1 is, what if I do not own the property? That's a good question. So I presume by that you lease the property. Now, capital allowance claims are still allowable to leaseholders as well as freeholders. What you might find is like it depends on the agreement you have with your landlord. If they do the bulk of any kind of renovation work, any capital expenditure, then the claim rests with them. But if you're spending money on let's say you completely gutted an empty shop and fitted it out yourself, then you might have the claim. So it's who spends the money is the key answer to that question. So you can still claim as a leaseholder if you spent the money. The next question is, how long does the claim process take? Now, I think this did crop up in the capital allowance section because I saw that question pop up. So for capital allowances and R&D to an extent, firstly, a lot of our hold-ups are often caused, unfortunately, by our clients being slow at providing us with information that we might need. But once we've got full information, then we can turn around claims very fast. Certainly with capital allowance reports, you know, as you're probably well aware, getting our surveyors into properties at the moment can be quite challenging given COVID restrictions. We've even found a workaround around that. But as long as the surveyors can get in, they'll write the report. And then if we've got all the information to hand, and what we mean by information is most recent accounts, perhaps a fixed asset register, we may have to speak to the solicitor who dealt with the purchase. So depending on the situation as to what information we need. But then once we submit it to HMRC, it should only take a few weeks to process. Likewise, I'll answer that question from an R&D perspective, even though I know it was asked for capital allowances. For R&D, likewise, we need information like accounts and tax returns. But once we've done your R&D consultation and drafted the report, then that gets submitted to HMRC, and HMRC have a service line agreement for R&D in that they process 95% of claims within 4 weeks. And then if you do a repayment, you tend to find it's another 2 weeks on top of that. So from us submitting to getting your money back, and then usually about 6 weeks for R&D. So hopefully that answers that question. Next question, does the capital allowance apply to semi-commercial properties, i.e. commercial and residential? Yes, it does, but the availability of what you get back can be quite restricted. So this is often the case where you've got commercial ground floor and then usually a flat up above. These shared residential commercial properties, often the claims when we crunch the numbers turn out to be very low, but it doesn't mean you can't claim. So we would look at those on a case-by-case basis, but they're not as generous as just a standalone commercial property. Next question, are R&D allowances permissible where the research and or development work is carried out by subcontractors or overseas entities? Yes, absolutely. Subcontractors is one of the qualifying costs for research and development tax relief. So if you employ a third party to carry out your R&D for you, so long as the project rests with you, so you're taking the financial risk and you've had the idea, then you can claim. And it doesn't matter if that R&D is if the subcontractors are UK or overseas. So hopefully that answers that question. If you're purchasing a pharmacy by way of an asset purchase, can you as the buyer get the benefit of the capital allowance pool? How would that work in practice? Yep, that's a really good question. So if you're buying the asset off someone else, then as long as that hasn't happened yet and you're still in negotiation, then this takes us back to that 2014 rule where the buyer and the seller elect. So if the seller hasn't claimed capital allowances already, then what they need to do is enter into an agreement that they'll make the claim and then pass on all the benefit to you. Or if the seller is a non-taxpayer, then it doesn't really matter. You don't need the election. But yes, you can as a part of an asset purchase get your capital allowances. And what you should find is as part of an asset purchase, if you're using a corporate commercial solicitor involved, they should be filling in what's called a CPSE, Commercial Property Standard Inquiries, and part of that asks all the questions about capital allowances, and that's where an expert should be appointed to make sure that you do get the benefit of the relief. Is it possible to make payment to Catax after claim received or approved from HMRC? With that one, yeah, with our R&D tax relief offering, what we normally do is we take our fee from the savings, so we receive the saving from HMRC on your behalf, net off our fee, which we've been open about. We'll tell you what it is in advance, and then send the net amount to you as the customer. With capital allowances, it works slightly differently because we provide the report to the accountant. So for capital allowances, once we know it's been submitted by the accountant, we know HMRC will process that within about 4 weeks. So we then raise our invoice on normal terms, and we wouldn't expect you to pay that until you've received your benefit, as we call it. Next one, I'm in the process of selling property. Can I still claim? Yes, you are in the absolute essential position that you should be making a claim. You know, you need to get that claim sorted before you sell the property. So that's absolutely key. If you don't make the claim before you sell, then firstly, your buyer's lost out. And secondly, you're potentially losing out. So it all depends on who the buyer and seller is, then what you do with your relief, because if you're still going to be a taxpayer, then you may want to keep the relief and then pass the no allowances over to the buyer, or a very small amount. If you're not going to be a taxpayer in the future, then you can maybe pass it over to the buyer and maybe get a better asking price for your property. So it becomes a bit of a negotiation tool on the price as well if the buyer's interested in the allowances. So if you're selling your property, you definitely want to be making a claim. Can I claim for property purchase in 2010? Yes, absolutely. That's ideal time because it's before the 2014 rule, but it's so recent that we've got access to good information. What is your fee structure percentage? Our percentage for capital allowances is based on the value of the items we identify. That ranges from 5% to 7% of the value we identify. For R&D tax relief, it works differently. It's based on the size of the saving you generate in the period, and that depends on a case-by-case basis on the potential size of the claim. So we look at that from a commercial point of view. Final question for the moment is, can you claim capital allowances for work carried on in customers' car park where there's a legal obligation to pay service charges? I don't see why not. I don't know what work has been carried out in the customer's car park. If it's just about retarmacking and making it tidier, then I'll probably class that more as a repair cost rather than capital. There was a new relief introduced in 2018 called Structures and Buildings Allowance, where you can claim for things like yards and car parks if it is capital. But if you're doing some kind of work that involves these integral features such as electrical, wiring or plumbing, then you could claim that as well under the relief I've spoken about. That seems to be the final question. I'll hand back over to Natalie.
Lovely. Nigel, thank you so much for that presentation. Very, very informative. And to our audience, thanks very much for attending. We have no questions that were unanswered, so I had some details for what we would do if that was the case, but no need. Well done, Nigel. Everything was answered. So thank you very much and good night.
Thank you.